We need to talk about price because Bitcoin's price is telling us a story most people aren't seeing. Meanwhile, Bitcoin is moving like dial-up internet in the 90s. While one of the world's go-to assets during periods of global stress is going parabolic. Again.
You're talking about gold, right? I thought this was a Bitcoin-only channel.
Yes. But wait, don't click off. Gold doesn't move like this unless something is wrong. Like sovereign nations preparing for some kind of massive currency devaluation. Wrong.
I'm listening.
Just this past week, the largest hedge fund manager in the world spoke. And what he said gives us a glimpse into what 2026 may look like. And more importantly, it helps us explain why the setup forming right now could be one of the most bullish moments for Bitcoin we've ever seen. I'm Oshins. This is Beyond Bitcoin. Let's dive in. Like I said in the intro, we need to talk about the price. Bitcoin is flatter than a pancake under a hydraulic press, but gold and silver are hockey sticking. And while most people shrug and say, that's boring, smart money doesn't shrug at gold. They pay attention.
Gold at all-time highs and people pawning their jewelry 13 years ago.
Yeah.
And then it was supposed to be the thing to hold during the 2010s. And now all of a sudden this year, why this year? And is it central banks? But that doesn't explain the rest of the metals trade.
No, right, it doesn't. I mean, I think what's going on is that the narrative has really changed. Like what we've been saying all along about gold is that it's an asset that's not replicable and it's nobody's liability. And that's why it's been the currency for millennia. And during a period of time when it was clear, when like the dollar took that role of the currency of the world, it wasn't clear as to why you should have gold. But now that we're seeing kind of cracks in the dollar, and that's partly because of what's happened with Russia's reserves being confiscated. Partly we saw with the big inflation because of all the money printing that happened during COVID.
Absolutely.
The rising national debt. So we're seeing now that the narrative has kind of been flipped on its head, and we are seeing reasons as to why gold is that currency, and I think that's what's driving the price.
Is something going on behind closed doors? Probably, because closed doors are usually closed, so something can go on behind them. Shouldn't Bitcoin be going up at the same rate? Well, historically, when gold makes such dramatic moves upwards, Bitcoin tends to follow it roughly in 2 to 3 months afterward, with similar violent moves. Gold is not a trade. Gold is fear with a long memory. And that brings us to a phrase that matters more than price targets. Recently, at the New York Times Dealbook Summit, Larry Fink, the world's largest asset manager, the CEO of BlackRock, described Bitcoin as an asset of fear. Not a meme, not a gamble, a hedge against things that are breaking.
I think we need to get back to what is the purpose? What is the purpose of Bitcoin? Then we get into stablecoin. The $13.5 trillion that BlackRock managed on behalf of our clients, it's basically managing hope. That's all it is. I mean, why would anybody invest in a 30-year outcome unless you're hopeful in 30 years you have the compounding effect? Bitcoin is an asset of fear. And when you're less fearful, like we had a trade agreement with China, you saw a shift downward. There is conversations this week that there may be some type of settlement in Ukraine. Bitcoin fell a little bit. So you own Bitcoin because you're frightened of your physical security. You own it because you're frightened of your financial security. The long-term fundamental reason you own it because of the debasement of financial assets because of deficits. And so to me, even the movement in the last week, and we've had a 20-25% drawdown, and this is the third time since IBIT was created, our ETF.
Then some people say, is that really insurance, right? If you had bought it at $125,000 and it's now sitting at $90-some-odd thousand, you're saying
if you bought it for a trade, it's a very volatile asset. You're going to have to be really good at market timing, which most people aren't. If you're buying it as a hedge against all your hope, then it has a meaningful impact on a portfolio.
An asset of fear. Did you hear that? That phrase matters because sovereign wealth funds don't chase upside, they price existential risk. And when they classify something as an asset of fear, they're saying this is what we hold when the rest of the system fails us.
And Americans need digital assets, and we're going to embrace this. And I think a massive advertisement for Bitcoin with the Ukrainian-Russian war, and especially the sanctions, where we seized $300 billion worth of treasury assets from the Russians. I think the Chinese have $3 trillion worth of assets, and that might have got their attention. And probably pretty much the conclusion is, if you're any nation state in the world and you think you might ever be in conflict with another nation state, and you're holding their credit derivatives or their currency derivatives or their currency or gold in one of their banks, that's not really proper anymore. So I think that's got everybody scratching their head saying, I don't trust the currency as a long-term store of value, A, and I don't trust my assets to not be seized, B, what am I going to do? And then right in the middle of that, you see things like Bitcoin poking their head up saying, check me out.
Now ask yourself, you hold Bitcoin, they're studying Bitcoin. That alone should change how you think about what you own. Let's ground this in reality. As I said before, a sovereign wealth fund isn't a hedge fund. It isn't a venture fund. It isn't day trading candles. It's a national survival vehicle. This fund exists to stabilize economies, preserve generational wealth, and protect against systematic failure. A move into Bitcoin to avoid existential risk may mean an imminent currency devaluation, where nations create trillions and money printer go burr. Could this be on the horizon for us?
So what are the consequences of another big print, of more inflation? Why is this so problematic?
Yeah, well, they're very simple. I mean, if you grow the money supply, you take rates down, which is what Trump wants to do, and you're forced into yield curve control. Let's talk about, let me define what yield curve control is. Let's just talk about that for a moment. I mean, we're in a sovereign debt crisis, and what that means is that the U.S. government is spending way too much money way too quickly, and the value of bonds have been going straight south, while the value of gold and Bitcoin, the alternatives, have been going straight north. And what's going to ultimately happen if we don't get this under control, and I think it's unlikely that we will, is that the U.S. federal government bonds are going to start to sell off even worse. And, you know, as you know, as most people now know, U.S. interest expenses are about $1.3 trillion. That's larger than defense. It's as large as Social Security. And you're going to get to the point where the interest expense is going to eat up the entire budget. And so you get into what James Lavish and I have called, and others have called, a debt death doom loop, where your interest costs go up. That makes your deficit larger. The larger deficit means you have to sell more bonds. You're selling bonds into a fixed supply of buyers of bonds. They don't want them at that interest rate, so the interest costs go up more, and you can see where we're heading here. So, and this has happened in the past, and so what happens to solve that, what the government does is they say, okay, fine, we're not going to let the interest rates go up beyond a certain point. We're going to institute what we call yield curve control, which means they are going to buy the bonds with money they print. And they can do that. I don't think any sovereign bond of the United States will ever default, because we won't let that happen. But you can effectively default if you print money to pay the bonds back. And so the bonds, yes, we're going to pay you what you're entitled to get in principal and interest, but what's it going to buy because of the inflation that's going to create? And so, it's not unusual to see this happen. It happens in emerging countries. It's happened in other countries that have pursued the policies that we're pursuing. And it actually kind of happened in the United States. I think there's a very interesting analog that I'd like to bring up. Coming out of World War II, we had about the same level of debt to GDP. It was around 110, 120%. And that was because obviously running the war was an existential threat, and we had to borrow a ton of money to get through World War II. And so, we came out of that. And when we were in that war, what the Fed did was they said, we're going to cap the short-term bills at 0.3%, and we're going to cap the longer-term, bonds at 2.5%. And so, people who owned those really got screwed. And they did that by using their own newly printed money to buy those bills and buy those bonds. Well, as you might imagine, that massively grew the money supply. And some people don't remember this, but it's a fact. I thought it was pointed out recently, and I retweeted on Twitter that, the CPI in June of 1947, the CPI was up 17.6% year over year. In, February of 1951, the CPI was up 21.0%. So what you see is, if we get into a situation where we're going to have yield curve control, the government's going to have to print a lot of money, fine, that printing is going to cause a lot more inflation. And so, the 9% inflation that we saw as the peak in the COVID example, it could become even higher in the next time around. And I remember the 70s very well. I was a teenager, but I remember the 70s very well. And there were like 3 waves of inflation. And history shows you once you get into an inflationary cycle, it's very hard to stop it.
Now here's where things get interesting and where most people miss the plot. As I mentioned, historically, gold moves first and Bitcoin follows later. Gold absorbs the fear and Bitcoin absorbs the monetary distrust. That's not ideology, that's observable behavior. Gold tells us something is wrong, and Bitcoin tells us that we can no longer trust the fix. And if gold is breaking out again, ask yourself what follows.
More, yeah. So
what do you want people to take away?
Well, there's a very important thing here. If you look at them correlated, and I'm kind of taking the more modern period. I mean, in the beginning, Bitcoin was just going nuts, and it's kind of unfair. It had an unfair advantage. So let's kind of take 2018 to present. The last 6-7 years. Bitcoin and gold have really traded in lockstep. I mean, they both represent protection from monetary debasement that can't be printed. Okay, that's first thing. Second thing is Bitcoin's performed more. It's gone up more than gold, and percentage-wise. But it's also been much more volatile than gold. So on the upswings, it goes up faster, but on the downswings, it goes down faster too, okay? And then the third point that I think is very important from the chart to take away is that gold is more widely distributed. Everybody owns it. The central banks are buying it. And I think it's going to be the first go-to solution for most people to protect themselves from monetary debasement because Bitcoin's new and it's riskier and it's volatile. Not everyone believes in it. And I understand that. I didn't believe in it in the beginning either. And so when monetary debasement starts to show up, gold tends to move first. It just does. And so the really best part of this chart, if you look at it, is you look at like 2019 and 2020 when the Powell pivot occurred because of the repo blowout. And then when we had COVID and we printed a ton of money, gold took off like a rocket ship. I mean, everyone's like, okay, I know what this money printing means. Buy gold. And they did. And it went up. Bitcoin was flatlined for quite some time. There was a real lag. And then one day Bitcoin woke up and said, oh, you know what? This is protection too. And they came into Bitcoin and it went up even more percentage-wise than gold. But there was a lag between the two. And then, of course, when we started tightening in 2022, gold went flat to down. Bitcoin collapsed. Bitcoin went way down. And so, it went from 65 to 15. And so, this is a volatile form of sound money.
And it's not just gold. Silver is also hitting all-time highs. This is where the survival thesis gets uncomfortable. Silver isn't just money, it's industrial necessity. And when silver starts moving with gold, it usually means one thing. Demand isn't speculative, it's defensive.
Even for you, look at platinum up 9%, silver's up another 9%. Copper. I mean, they always joke the cure for high prices is high prices, and that's more because you might bring on more supply. I don't know how realistic that is, but also just because on some level you get this kind of speculative fervor breaking out. I can't imagine you want that because it's going to make the whole asset class more volatile, I'd imagine.
Right. I mean, I'd say, silver definitely looks at this point, somewhat overbought. There are things going on relative to export restrictions from China relative to silver. Like you say about supply, it's unlikely. Supply really can't come online unless people do start selling their gold jewelry like they did back in the day. We aren't really seeing that. So it's like, I'm never going to argue with high prices, considering that we manage a gold fund. But I think gold has been pretty orderly. The silver trade's been maybe that's a little bit overextended. Yeah. But gold's been pretty orderly, and we'll take it.
Gold, silver, Bitcoin, they're all different assets, but they all share the same message. Survival assets are pumping, and survival assets don't pump because some influencer on TikTok got excited.
And I have said we will have $5 days. I just said that like 2 weeks ago. So here we are, guys. We're going to have $10 days next.
And here's the uncomfortable truth. Retail investors debate price targets, but sovereign funds debate system stability. They're asking themselves, what happens if our debt can't be rolled over? What happens if our currencies fracture? What happens if the trust in our system collapses? And Bitcoin quietly sits there with no counterparty risk, no dilution, no political discretion. When sovereign wealth funds start considering Bitcoin, they're not asking, will it 10x? They're asking, what still works if everything else doesn't? The good news is you already own it, right? Right. And this is the part that people avoid saying out loud. You don't need more Bitcoin to benefit from this shift. You just need conviction alignment. If sovereign capital is accumulating Bitcoin slowly, quietly, strategically, then volatility isn't your enemy. Misunderstanding is. If Bitcoin is becoming a survival asset, then holding it isn't passive, it's positioning. So let's recap. Gold and silver are breaking all-time highs, and Bitcoin will likely follow. Sovereign wealth funds are circling around Bitcoin, and Larry Fink is calling it an asset of fear. These are not isolated events. They're one story, a story about survival. And the smartest money in the room isn't chasing yield. It's preparing for reality. Thank you so much for watching this video. If you like what you see and you want to see more, make sure you hit that like button below. Or you can subscribe to the Simply Bitcoin channel for more content like this. We're coming out with it every single day of the week. Also, don't forget to hit that notification bell. I'm Oshins. This is Beyond Bitcoin. Until next time.